This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning John Rubino. John is a well-recognized author, has published a number of books, and is the publisher currently of the website dollarcollapse.com. We will continue from session 1, already in progress. We're going to talk about Argentina.
One of the aspects of a currency war is that you see a lot of collateral damage, and countries that are either mismanaged and see that their mismanagement being really exacerbated by the fact that the big guys are pushing down the value of their currencies, or who are managed well and are hurt because all the hot money flows in looking for a safe haven. Argentina is one of the former. They're grossly mismanaged, and historically they have been. They do stuff like this every generation, it seems like, and so their debt has gone through the roof lately. Government spending is through the roof, and they're being forced to take really aggressive actions in order to protect themselves. And they just implemented price controls, which is really the last stage of a country that's actively destroying their currency. They won't let grocery stores raise their prices anymore, as if that is any kind of a solution. History is pretty clear on this, that that's what happens before a collapse.
Well, the last time they got into this problem, they nationalized the stores that were increasing prices. They took them over.
Yeah.
This is nothing new, but, I think Argentina is just a beautiful case study of what's in front of us. I mean, they've been through it, and now they're going through it again. And I said earlier at the beginning, John, the types of controls that come when you start to get into a currency war. Because if you're the belligerent, we were talking about the belligerents, who are basically the developed world that have too big a legacy entitlement and much too big a debt. And the only way out of it is not just to increase a competitive advantage on trade, it's also to devalue their debt. That's the essence of what they're trying to do, as they've driven down real rates to such a level. The only way that they can get rates down, not so much lower, but to keep interest rates low, is to get the price of the bonds up. Therefore, you drive your currency value down. That's the game of what the belligerents are doing. If you're on the receiving end and you're like Argentina, you say, how can I stop this? I'm just getting a barrage of mortar shells coming in here. What they do then is they've got to go to capital controls, exchange controls, as I mentioned earlier, wage controls, price controls, trade controls, etc., which in itself starts to manifest itself into all sorts of problems. John, the reason I'm into this is I wrote my thesis paper in 2011 was on Beggar Thy Neighbor. And so it was about currency wars and the balance with trade wars. And I went through and I looked at many places, one of which was Argentina. That's why I saw these kinds of things. But when I wrote the next thesis paper I wrote in 2012, which was on financial repression and all the elements of getting down to zero interest real rates, I realized then how central a currency war and using currency as the base denomination of your bonds, which is how you were going to control people taking more risk and the low rates and to devalue your debt structure, how central it was to force that, which was really seen. And this year, when I was writing my last thesis paper on statism, it gets into the amount of advance we're seeing in controls, the government having to control financial through fiscal policy, economics through monetary policy, political control through public policy, but so much control that we're seeing every day that's coming in, because if they lose this balance, in many ways, the system will implode. In other words, they're forcing us to do things that we don't typically want to do. And you see it in Argentina. They've nationalized the private pensions, which is plundering the retirement savings of their people. And that we're starting to talk about that in America. They've increased tax rates across the board. We're already into that, are we not? They've inflated the money supply. We've been talking about that. They've driven the value and purchasing power of their currency down by 50%. They make a mockery of official statistics. And there's just a whole list here that I have up of things that they've done, and we are following right along on that. We're on a path that we have no choice but to play out. And there's an inevitable end to it, and it's a currency collapse.
Gordon, you're right. We are Argentina in a lot of ways. You know, we have more credibility built up over the years, so we can get away with it longer. Yeah.
John, currently. But what's going to happen? We'll go back to your comment on sentiment. That sentiment, well, there'll be a realization. And that's when you get a crack up boom. That's when you get hyperinflation. Hyperinflation comes not from prices going up, but the currency gets devalued. It's a currency problem. And currency's one of confidence and perceptions. And when it changes, it doesn't change over months and months and a year. It changes within weeks and days. Mm-hmm. If there's one lesson out of the Weimar Republic, when that happens, how quickly it happens.
Mm-hmm.
We're not there yet.
No.
In spite of what I said earlier, I think we got a lot more games that are going to be played here. Is this a real clear path? The signposts are very clear what you should look for. We're following right along. You don't even need GPS. You just need to look out the front window here.
Mm-hmm. Yeah, very true. Venezuela, for instance, is another version of Argentina, basically. Extremely badly managed Latin American country. And they already have a lot of capital controls in place and just recently devalued their currency by 32%. And at the same time, they've informed supermarkets that they don't need to raise their prices because the currency is stable domestically, and this is strictly a foreign exchange issue. And so what will happen next is that obviously merchants won't keep their prices the same when the currency has been devalued by a third. They'll start trying to raise the prices, and then we'll get price controls imposed on them. So we're seeing basically the same process at work in both of these countries. Meanwhile, Switzerland is an example of a country that is basically run right and is still a victim of the global currency war because so much hot money was flowing into Switzerland trying to escape the Eurozone crisis that the Swiss franc was being bid up to a point where it was devastating Swiss export companies. So Switzerland was forced to peg the Swiss franc to the euro, which means it's going to be adopting Eurozone level inflation going forward. So they're no longer a hard currency country. They're now going to have to inflate right along with the Eurozone. And that's something that is so alien to Swiss culture, but they have no choice because they're a small country. And they're a mouse in the grass when the elephants are fighting. So they basically have to just get out of the way and do what they can to survive. And so nobody is really safe when the biggest economies of the world decide to enter a currency war.
It goes back to our discussion we've had on debt. And we've had such big growth of debt through securitization that they're terrified right now of collateral contagion because all this debt is based on collateral that supports it. But unfortunately right now, the collateral itself is in fact not there. If you don't have a job, your house is not worth what it was when you had a job. So as growth is stagnating, the consumer isn't spending. EBITDAs, which are collapsing in the corporate America around the world from corporations, which is very telling, which is their free cash flow. As that starts to stall, what it means is those asset values, that collateral isn't what it was worth before. So when you have something that's going on that makes the housing boom seem like a minor amount, something called rehyperification, because we're now pledging debt as collateral with unlimited leverage. So it's just being rolled from one player, one counterparty to the other. They have no idea in the shadow banking just how much rehyperification and collateralized debt is out there. The point I'm getting to, John, is that asset collateral value is crumbling. Now, the only way you can shore it up is you got to get the cost of money down. So that's why you get real rates compressed to zero, long duration, which is what the whole essence of financial repression for a number of reasons, but one of which is to make this collateral acceptable. And you're seeing that in Europe. What they'll accept now is collateral. But now the problem is you can't take interest rates down below zero in real terms. They're even much more below zero. What do you do now? Well, this is my point. The only solution then, if you're a fiat, is to drive your currency value down at a lower level relative to the other currency, because that's the way you debase your debt and get yourself out from under it. That's what they're trying to do. That's a complicated way of going through it, but that's where the central bankers' minds are. They're not chasing growth. I mean, they want it. They're not looking to improve their trade balances. They want it. Yeah. They're terrified of the debt imploding on them right now.
Yeah. And they are basically doing whatever they have to do to keep that from happening. And I think they're doing it without any real plan in mind, because their theories that they learned in college and that they've lived with for the last 30 or 40 years no longer work. The things that they used to think, the Keynesian prescription for a slowing economy is to run a big deficit and to increase the money supply. Well, that really hasn't worked so far, has it?
Been a disaster. And now you've got Martin Wolf out this week, who's a leading, I'll call him, mouthpiece for trial balloons throughout Europe. And his article is on the case for helicopter money. In other words, printing money should be standard public policy. And when I talk about printing money, I'm talking unlimited, and he even talks about the benefit of handling it directly to the public.
Yeah.
What's wrong with this scenario?
Well, it's the inevitable final stage of this process, because nothing else is working. So you're getting intellectual justification. See, these guys were always out there saying this stuff. Paul Krugman has said what he said for a really long time. And Martin Wolf has been a spokesman for big government and easy money for a long time. But now they're getting a higher and higher profile because there's really nothing left in the toolbox of traditional central banking and treasury management. So all that's left is just to open the floodgates. And so you get a lot of talk about debt jubilees and debt monetization and quantitative easing as, a reasonable prescription, instead of something that is extremely radical. You never heard anything about this 5 or 10 years ago. These things were so far off the radar screen as to be invisible almost. They were ideas of the extreme fringe left in the world of economics. And now they're mainstream. And the reason for that is because they're all that's left. There's only that or a collapse. And since nobody in power can accept a debt-driven collapse of the economy, if they want to stay in office and retire with any kind of a reputation intact, the only thing that's left for them is to flood the system with cash. So the printing presses have no choice but to run flat out from now on. Which is to say, we have no choice but to go through a global currency war.
Which is happening, will accelerate, but then will quickly start to change from there. And that is that the currency war is only going to be raced within those that are completely fiat currencies. So you're seeing other currencies trying to attempt to back themselves with higher gold. And I'm not trying to just support gold here. I'm trying to argue that they see the inevitability of what's going to happen and are trying to position their countries with stability. For example, China buying over 1,000 tons officially of gold per year. Russia has been very, very clear it can't buy gold fast enough, etc. So once you get outside of those four currencies, you get into the BRIC countries, all you see is they are buying real assets, gold is one example, to try and take their currency reserve and diffuse them. They know what's going to happen here. Right now, large money won't invest in those areas, invest in those currencies yet, but there's going to come a day where that sentiment's going to change and they're going to go that. And it'll start with some kind of event where counterparties start to fail. Because this, you can paper it over, but non-performing loans and malinvestment is exactly that.
Yeah, it's important to understand the world that China and Russia see when they look outward. It's obvious to them that we're actively trying to lower the value of our currencies, and that eventually we'll succeed because we have an unlimited printing press. But meanwhile, we're able to fool the world into continuing to buy treasury bonds and euro-denominated bonds. And that allows the Russians and the Chinese, who have built up huge positions in U.S. and European debt, to sell that debt into a strong market, and then to turn around and buy precious metals, gold especially, at relatively low prices, because we've been able to, in the U.S. and Europe, we've been able to depress the price of gold while supporting the price of our bonds. So that gives the Chinese and the Russians exactly the kind of market they want to make this transition. They can sell their bonds out at a profit and use the proceeds to buy cheap gold. And they're doing it. They're doing it aggressively. And I think they would love to have the current market continue for a few more years, because imagine how much gold those guys will have at their current rate of accumulation if they have 3 or 4 more years of this.
John, you're absolutely right. That is exactly, in my opinion, what they're trying to do. Austrians call it the indirect exchange.
Yeah.
They're trying to substitute, because they no longer buy any U.S. debt, Russia or China. They can't dump it or it causes other kind of problems. What they do is they begin to exchange it. So they're building their gold and they want to keep the trade in balance until they can migrate out. And then at some point, you'll see that their currency will be some level gold backed. And then when that happens, the money will start to change. And we're already seeing, as we've talked about in previous shows, the need for the U.S. dollar, because the less trade is conducted today in U.S. dollars. The whole petrodollar issue means that as a U.S. dollar reserve, the $6 trillion that's out there doesn't need to be there. It's going to be returned. And they know that's coming.
Yeah, and another important point here, Gord, is that China recently surpassed the U.S. as the biggest trading country in the world. They do more foreign trade than anybody else, which means that there's a huge imbalance out there in terms of what their currencies are used for. The U.S. dollar is still used for the majority of transactions in global trade, while the yuan is 5 or 10% of global trade right now. Mm-hmm. And so we're going to see a natural rebalancing, independent of everything else, of currency valuations and currency usages out there, just because more Chinese goods are circulating out in the world than U.S. goods right now. And so it's logical that the yuan will become a trading currency and therefore a reserve currency on its own, even leaving the whole gold and gold flow thing aside. But at some point, like you said, 3 or 4 years down the road, it's going to be very easy for Russia and China to announce gold backing of their currencies, or maybe even announce a combined currency that will be the world's reserve currency that's backed by gold and, instantly outshines the dollar and the euro when that happens. And it wouldn't be a surprise if that is their intermediate term plan. They're acting as if it is, and it's logical that it would be. So we'll see. That's a really easy to picture way for the currency war to evolve to where the yen and the dollar and the euro cause so much damage to each other on the way down that it opens the field to a strong new gold-backed currency, and China and Russia are perfectly positioned to provide it when the time comes.
The last thing they need is somebody to do something stupid. And I think they're most worried about coming out from the West with the political reactions and accelerating the rate that they're debasing here right now, because they've basically practiced a very sophisticated game of vendor financing for many years to grow their economies. But now they want to start to migrate it. So I think that you will see them announce I think they're going to want to go to as an alternative currency solution, so that there'll be a slow and a gradual shift. And you see some of the preliminary balloons coming up out of the IMF of migration away from the U.S. dollar as a reserve currency. In an ideal world, if we could get agreements, we could manage our way out of this in a rebalancing and readjustments of standard of living. It isn't going to happen. World is much too complex. Things will break. It's not robust. These are fragile systems, and politicians can't take to the public of the developed world the magnitude and standard of living adjustments that they're going to have to go through and are going through, as we see the middle class and disposable income absolutely crushed because we consume more than we produce. That's the bottom line. When you consume more than you produce, it's unsustainable.
Yeah, assuming there was a political fix at this point, which I'm kind of skeptical that there's anything we can do with this much debt to avoid some kind of a massive, painful transition. But assuming there was a solution, you couldn't sell it politically to anybody right now. We found that out in the U.S. election here. We voted for more free stuff, among other things. I mean, this was a complex election here, but the gist of it was a debate between more government and less government.
Usually when you get into these kinds of problems, John, what happens is, that's like in the 30s, it ended with the Second World War. There's usually a major destabilizing event that becomes something that becomes the cover the screen that forces this massive readjustments that have to go on that would be totally unacceptable to the public. In a time of war, and I'm not saying there's going to be a war, but in time of war, you sacrifice, you go without, you do it for all sorts of reasons that without a war you wouldn't do, or things you would put up with. So that's usually what happens. There's a significant crisis. Some people are talking about that as being the potential, but I think it'll take a different form this time. And later this week, we're going to talk about the new type of warfare called cyber war and how disruptive it can be and how it can affect economic, financial, and cultural issues in a very foul sweep. And if your ATMs aren't working, or if you've got TVs that aren't working and you've got other kinds of issues, you'll find out today just what you're willing to sacrifice to get it back and get things back to something normal. John, we're out way past our deadline, so we gotta wrap here. Any kind of closing comments you'd like to make? We're going to talk about currency wars many times this year, but here today?
Yeah, no, I think we covered it for now, Gord. We'll come back to this, like you said, at a later date and update everybody.
I'm looking forward to having you back here later this week. And as I said, we're going to talk about cyber wars and a whole new type of war. So looking forward to that. Talk to you later.
Great. Thanks, Gord.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.